You know what your car has in common with the 2008 mortgage crisis? No? Seriously? Right now, sitting in a parking lot somewhere, there's a car that costs more than its owner can earn in an entire year. And that's not an accident. It's a system. Listen to this story. In 2023, a woman in Texas bought a Chevy Tahoe for $84,000. Loan term? 96 months, 8 years. Interest rate? 18%. By the end of the loan, she will have paid $156,000 for a car that by then will be worth maybe $15,000. This isn't an exception. This is the norm. Today we are going to break down how Wall Street turned the automobile from a means of transportation into a financial trap, and why 1.6 trillion in auto loans might be the next domino to fall, and why the analysts who predicted the 2008 crash are sounding the alarm again right now. But let's start from the moment when things began to go wrong. In the 1980s, everything was simple and straightforward. You want a car? You buy one. You save up cash, pay outright, or, if you really have to, you take out a loan for no more than 3 years. The average price of a new car was around $7,000. That's roughly $20,000 in today's money after adjusting for inflation. Car companies made money by selling cars. Makes sense, right? You build a product, sell it for more than it cost to produce, and keep the margin. Capitalism 101, and then the Wall Street geniuses showed up. In the early 1990s, the major automakers, GM, Ford, Chrysler, created their own financial divisions. GM launched GMAC, now Ally Financial. Ford created Ford Motor Credit. And suddenly they discovered something interesting. You can make more money financing cars than selling them, a lot more. Picture this business model. You sell a car for $30,000. The margin after all expenses? Maybe $2,000, $3,000. Not bad. Now instead, you give the customer a loan at 8% interest for 7 years. That same customer will pay an additional $10,000 just in interest, plus late fees, plus insurance add-ons, plus various charges. Suddenly your margin isn't $3,000, it's $15,000. The game changed completely, and then the machine started rolling. In the late 1990s, auto loans began to be bundled into bonds and sold to investors, just like mortgages before 2008. It's called securitization. Sounds boring, but the idea is simple. The bank gives you an auto loan. Then it takes your loan, mixes it with thousands of others, packages it into a nice financial product, and sells it to Wall Street investors. Pension funds, hedge funds, insurance companies, everyone buys securities backed by auto loans. For the bank, it's brilliant. It issues a loan, immediately sells off the risk, gets fresh cash, and uses that cash to issue even more loans. The conveyor belt starts turning. And here's the key point. The car stopped being the product. The loan became the product. Automakers no longer care about selling you a great car that will last 15 years. They care about selling you a debt that you will be servicing for the next 7 or 8 years. And ideally, you will come back in 4 years for a new loan because your current car is outdated or not what it used to be. Planned obsolescence met financial engineering, the perfect storm for the consumer. Look at the numbers today. GM Financial brings in billions in profit every year, often more than GM's actual car manufacturing. 85% of new cars in America are bought on credit. Do you think people suddenly got richer? No. Loans just became easier. And the average loan length? In 2024, 68 months, almost 6 years. It used to be paid off in 3 years, and now people stretch payments over 6 or 7. And loans for 84 months, 7 years, already make up 16% of all new auto loans. Now there are even 96-month loans, 8 years. In 8 years, a child can go from first grade to middle school. And you're still paying for the same car. But here's the question almost no one asks. How do you force people to take out bigger and bigger loans for more and more expensive cars, especially when their incomes are rising? To do that, you had to change America itself. And that process started 70 years before the financial boom. Imagine you can't get to work without a car. Not because you're lazy, but because there are simply no other options. The bus comes once an hour, and the route doesn't work for you. A bike? 25 kilometers along a highway with no bike lane. That's suicide. Walking? Don't even joke, this isn't an accident. It was engineered. In the 1920s and 30s, American cities had extensive streetcar and rail systems. Los Angeles, the modern symbol of car dependency, once had one of the largest streetcar networks in the world. You could get almost anywhere by public transit. And then General Motors entered the game. In 1936, GM, together with Standard Oil and tire giant Firestone, created a company called National City Lines. Officially, it was a public transport operator. In reality, a machine designed to eliminate competition. The scheme was simple and brilliant. National City Lines bought out companies that operated streetcars in different cities. Then those streetcar lines were shut down under the pretext of inefficiency and replaced by buses. And guess who manufactured those buses? GM. By the 1950s, streetcar lines were disappearing across America. Los Angeles, Detroit, Philadelphia, Baltimore, one city after another lost its public transit. In 1949, GM and its partners were found guilty of antitrust conspiracy. The fine? $5,000. $5,000. That's not a typo. For destroying the transportation infrastructure of an entire nation, they paid less than the price of a used car. Meanwhile, another campaign was unfolding. After World War II, the U.S. government launched the construction of the interstate highway system. Official reason? National security, to quickly move troops in case of invasion. Real reason? The automobile lobby was unbelievably powerful, and building highways meant billions of dollars in contracts for car makers, oil companies, and asphalt manufacturers. Money that could have gone into railroads, subways, and public transit went into roads. For cars, then came the era of suburbs. Cheap post-war housing loans allowed millions of families to buy homes outside cities. But these homes were built following a new model. Far from the center, far from work, far from shops. Walkability? Forget it. Distances weren't measured in minutes of walking, but in miles of driving. Your home in one place, your job 20-30 kilometers away, the school in another direction, the supermarket in yet another. Even buying milk without a car turned into a 1-hour mission. Zoning laws cemented the model. Residential zones here, commercial zones there, industrial zones somewhere else entirely. Mixed-use development, shops under apartment buildings, was dismissed as something that lowers property values. Public transit. That's for poor people, ads and movies said. A successful person drives their own car. A big, shiny one. For decades, advertising sold a dream. A car isn't transportation, it's freedom. Open road, wind in your hair, independence. The American dream on 4 wheels. A Cadillac in the driveway. The symbol of success. A pretty picture. But the reality? A car is an obligation. A monthly loan payment. Insurance, which in some states costs $200, $300 a month. Gas, repairs, maintenance, parking, fines, taxes, registration. Research shows the average American spends about $10,000 a year on owning a car. That's more than many countries spend on healthcare per person. And here's the really funny part. Americans didn't choose this life. Cars were chosen for them 70 years ago, when planners, politicians, and corporations decided that the country would be built around automobiles, not people. Today, 91% of American households own at least one car. 57% own 2 or more. In the suburbs, you literally can't work without a car. No car, no job. No job, you can't buy a car. A perfect loop. The average American spends 293 hours a year behind the wheel. That's more than 7 full work weeks. Imagine. Almost 2 months of your life every year are spent sitting in traffic and driving from point A to point B. Critics of this system say, this isn't freedom. This is dependency. You're not choosing how to move around. You're forced to own a car. And if you're forced to own something, that's not freedom, that's necessity. And now, when a car has become an absolute requirement for survival in American society, prices can be raised, loans can be stretched, and increasingly elaborate debt schemes can be invented. Because you can't give up the car. At all. Let's break down how buying a car works today. Spoiler, it has a brilliant system, one that is almost impossible to escape without losing money. Mechanism. 1. Stretching the loan terms. Decades ago, an auto loan lasted 36 months, 3 years, and you were free. That was the standard in the 1970s and 80s. Why 3 years? Because in that time, a car didn't lose a huge chunk of its value, and by the time you finished paying it off, the car was still worth roughly what you paid for it. Today, the standard is 72-84 months, 6 to 7 years. The dealer smiles and says, just $400 a month. Sounds affordable, right? Much nicer than paying $800 a month for 4 years. Now let's do the math the dealer absolutely does not want you to do. You buy a new car for $40,000. You take out a 7-year loan at 8% APR. Your monthly payment looks fine, about $600, but after 5 years, just 5, your car has lost roughly 60% of its value. Now it's worth around $16,000 on the used market, and you still owe the bank around $18,000. Congratulations, you're underwater. Your loan is bigger than the value of your car. In English, underwater or upside down. And this isn't rare, this is normal for long-term auto loans. In 2023, about 23% of all auto borrowers were underwater, almost a quarter. Mechanism 2. Negative equity and the rolling snowball. Negative equity is the nightmare you can't wake up from. Imagine this. You've been paying off a $35,000 car for 3 years. You're tired of it, or it keeps breaking, or you simply want something new. You go to the dealer. The dealer appraises your car. We can give you $15,000 for it. But you still owe the bank $22,000. That's $7,000 in negative equity. A normal reaction would be, okay, I'll wait a couple more years and pay it off. But the dealer says the magic words, no problem, we'll just add your old loan to your new one. That is rolling negative equity. Your old debt is carried into the next loan. So now you buy a $40,000 car. But your loan is written for $47,000. You owe $47,000 for a car worth $40,000. You're underwater from day one. And here's the scary part. A few years later, the same thing happens, but worse. Now, the negative equity isn't $7,000, it's $12,000, then $18,000. Each new loan drags the previous debts behind it, like a snowball rolling downhill. People end up owing $60,000 on a car worth $30,000. The only escape? Pay the difference in cash. Most can't. Or default and destroy your credit score. It's a financial prison. The cycle is closed. You're trapped in perpetual debt. Mechanism 3. Predatory interest rates. Now let's talk interest. If you have a good credit score, 750 plus, you can get 5 to 7% APR. Not bad. But if your score is under 600, welcome to the world of 15 to 20% and sometimes 25% APR. Imagine a $30,000 loan, 7 years, 20% APR. The monthly payment is still only around $600, but by the end, you'll have paid about $50,000. For a car that cost $30,000 and is now worth maybe $10,000. You paid $20,000 in interest alone, more than half the cost of the car. This is subprime auto lending, and it's huge. In 2024, about 20% of auto loans went to subprime borrowers. And here's the kicker. Dealers get commission for increasing your interest rate. The bank approves you at 8%. The dealer says, the best I can do is 12%. You accept because you need a car. The dealer pockets the difference. It's legal, they're called dealer markup. Then come the hidden fees. Documentation fee, $500, $800. Processing fee, $300, $600. Vehicle preparation, $400 to $1,000. They don't prepare anything. Pure profit. And the add-ons. Gap insurance, extended warranty, tire and wheel protection, maintenance plans. All sound reasonable, but add 5K to the loan. Most people never use them. Mechanism 4. Inflated prices and the monthly payment trick. The average new car price in 2025 is $48,000. In 2000 it was $22,000, about $38,000 in today's dollars. Prices are rising faster than inflation. Why? Officially, cars are more complex, safer, more high-tech. Unofficially, because they can, because people keep buying, because people don't look at the total price. They look at the monthly payment. This is the psychological foundation of the whole business. A dealer never asks, what can you actually afford? A dealer asks, what monthly payment works for you? Well, I can manage $500 a month. Perfect! We have the perfect car for $500 a month. You don't ask. For how long? At what interest? What's the total cost? And the dealer doesn't tell you that it's 8 years at 12% APR, totaling $48,000 for a car that costs $35,000. Because $500 a month feels fine, $48,000 feels insane. This is the classic manipulation. Break a huge, scary number into small, digestible pieces. The human brain is terrible at long-term math, but excellent at short-term comfort. Then comes psychological trick number 2. When the bank says you're approved, it feels like a victory, as if you've earned something, as if you've won. In reality, they mean, welcome to 7 years of debt you can't easily escape. Remember, a bank doesn't give you money, a bank gives you obligations. One more thing, the median U.S. household income is about $75,000. The average new car costs $48,000. That's 64% of an entire year's income for one vehicle. In the 1980s, a car cost about 30–40% of a household's annual income. Now it's nearly 65%, but people keep buying. Because it's just $500 a month. The question isn't whether this looks like a bubble. The question is how big the explosion will be. Let's look at the numbers that are genuinely frightening. And I want you to really picture the scale. $1.6 trillion in auto loans. That's more than the GDP of most countries, more than the entire economy of Canada or Spain. More than 7 million Americans, 7 million, are over 90 days past due. That's the population of Switzerland, except these people can't pay for their cars. And here's the scary part. Delinquencies are rising fastest among subprime borrowers. You've heard that word before, right? Subprime? The same group that blew up the housing market in 2008. Now let's play a game. Find 10 differences between 2008 and today. The problem? There are almost none. Parallel number 1, securitization. In 2008, banks took mortgages, bundled them into complex financial instruments, CDOs, MBS, and sold them to investors worldwide. German pension funds were buying bonds backed by the mortgage of some guy in Florida who had zero chance of paying it back. Today? Same thing. Auto loans are bundled into ABS, asset-backed securities. Sounds solid, right? Except the assets are cars that lose 20% of their value the moment they leave the dealership. The U.S. auto loan ABS market is over $100 billion per year. And who buys them? The same pension funds, hedge funds, and investors who supposedly learned the lesson of 2008. Well, maybe not. Parallel number 2, predatory lending. Remember how in 2007 banks gave mortgages to anyone breathing? No income, no job, no assets, ninja loans. Because banks didn't care. They'd sell the loan anyway. Now it's happening with auto loans. Credit score 500? No problem. 22% interest? You're approved. Just got out of prison. Welcome to the auto financing industry. There is even a term now, deep subprime auto loans. Loans to people with credit scores under 550. 1 in 4 ends in default. 1 in 4. But lenders don't care, because they profit up front, then package these toxic loans into bonds and sell them. Parallel number 3, the phrase, "this time is different." In 2007, economists said, home prices can't fall everywhere at once. Impossible. The housing market is stable. Guess what they say now about auto loans? This is different. Auto loans are much safer. We've learned a lot since 2008. Our risk management is better. The most dangerous words in finance, this time is different. When bankers start saying that, grab popcorn. Parallel number 4, negative equity. In 2008, millions were underwater. They owed more than their homes were worth. Prices collapsed, debt remained, a nightmare. Today, same thing with cars. About 23%, almost 1/4, of auto borrowers have negative equity. They owe more than the car is worth. Average negative equity, $6,000, meaning someone owes 25K while the car is worth 19K. Where did the 6K go? Evaporated. The car depreciated faster than the loan was paid down. Now imagine a recession hits. People lose jobs. Payments stop. Banks repossess vehicles, millions of them. What happens to prices when a flood of used cars hits the market? They fall. Hard. A 19K car becomes a 14K car. But the borrower still owes 25K. Now they're 11K underwater. And the snowball begins, the chain reaction, step by step. Step 1. Mass defaults. Unemployment rises by a couple of percentage points. Not catastrophic, but enough to force millions to choose between food and their car payment. Guess what they choose? Food. Step 2. Repossessions skyrocket. The US already repossesses about 2 million cars a year, the highest since 2009. Imagine that number doubling. Step 3. Used car market collapses. Dealers can't sell the flood of cars, prices crash. Step 4. Investors panic. Auto loan, ABS lose value. Investors rush to sell. The market cracks. Step 5. Credit freezes, banks stop approving loans. Requirements tighten, rates rise. People who got approved last month now get rejected. Step 6. New car sales collapse. If no one can get a loan, who buys $50,000 cars? Sales drop 20–30%. Step 7. Automakers panic. GM, Ford, Stellantis/production. Factories close. Thousands lose jobs. Step 8. Unemployment rises further. Laid-off workers can't pay their own loans. More defaults. Step 9. Back to step 1. The cycle loops. This is a death spiral. Once it starts, you can't easily stop it. Signs of trouble already here. 1. Subprime delinquencies are already above 2007-2008 levels. 2. Average loan duration is at a record 68 months. That's not convenience, that's desperation. 3. Average auto payment is $734 a month. More than rent in some cities, more than utilities, more than food. 4. 17% of borrowers spend over 10% of income on car payments. 5. Automakers are offering heavy incentives just to keep sales alive. 6. Major banks are tightening lending. JP Morgan, Bank of America, they've seen enough. So how is this not 2008? Skeptics say, auto loans are smaller, cars aren't houses. This can't crash the whole economy. True, there are differences. Difference number 1, size. An average auto loan is 30–40K, not 300K. Difference number 2, repossession is fast. You can take a car in weeks, not months. Difference number 3, spread across the country. Not concentrated like housing was, but these differences don't make the system safe. In some ways, they make it more dangerous. Why? Because in America, a car isn't a luxury. It's survival. Lose your car, lose your job, lose everything else. In 2008, someone could lose their house but still commute to work and rebuild. If you lose your car in a suburb with no public transit, you're done. The first domino is always the car, the core issue. It's not that every auto loan will explode. Most people will keep paying. The problem is that the entire system is built on the assumption that almost everyone will keep paying. If one assumption breaks, defaults rise, used car prices fall, people stop refinancing. The whole structure collapses. Experts say, we have stress tests, we're prepared. Their worst-case scenario, defaults rising by 2–3%. But what if they rise by 10% or 15%? They say, that's impossible, not in our models. They said the same thing in 2007. Then Bear Stearns collapsed, then Lehman Brothers. Turns out the models were wrong. Final thought. I'm not saying the auto loan crisis hits tomorrow, or next month, or next year. Maybe the system limps along. Maybe I'm overreacting. But all the ingredients are here. Massive debt, falling borrower quality, overpriced assets, complex financial instruments no one truly understands, regulators looking the other way. It's the recipe for catastrophe. And when it comes, because history says it will, the ones who suffer won't be the architects of this system. It'll be ordinary people who just needed a way to get to work. So what does this mean for you? For me? For all of us? Let's start with the practical side, because it's easy to philosophize about systemic risks. But what should an ordinary person do who simply wants to buy a car without going broke? For ordinary people, rules of survival. Rule 1. The most important. Avoid car loans longer than 4 years. I'm serious. If they offer to stretch it over 6 or 7 years, that's a red flag the size of a football field. Why? Because the math works against you. A car loses value faster than you pay down the debt. After 3 years, you will owe more than the car is worth, and then you're trapped. The dealer will say, but the monthly payment will be lower. Yes, it will. But the total amount you pay will be huge, and you'll be tied to that car for years. Rule 2, buy a car cheaper than what the bank approved. Banks approve the maximum amount you can theoretically afford to pay. Not the amount you should take. They want to earn the maximum interest. Their incentive is to lend you as much as possible. Your incentive should be the opposite. Borrow as little as possible. Rule 3, a used car that is 2 to 3 years old is the golden middle. The car has already lost the biggest chunk of its value. New cars lose 20–30% in the first year, but is still new enough to be reliable. You avoid the newness tax, that silly overpayment just to be the first one behind the wheel. The previous owner already paid it for you. Rule 4, the most controversial, but I'll say it. If you can't pay cash for at least 50% of the car you want, you can't afford that car. Want a $40,000 car? Do you have $20,000 in cash? No? Then look for something in the $20,000, $25,000 range. It's a harsh rule, and many will say, but I need a car right now, I can't wait to save. I understand. The system is built so you can't wait. But every time you take a loan for a car you can't afford, you're entering a years-long trap. Rule 5. Read the fine print, especially the interest rate, prepayment penalties, hidden fees. Dealers make money on people not reading contracts. If they tell you, this is a standard contract, everyone signs it. That's a sign you need to read it especially carefully. But let's be honest, these rules will help you individually, but they don't solve the systemic problem, because the system doesn't want you to follow them. The system wants you to take the biggest loan for the longest term at the highest possible interest rate, because that's how it earns money. Now we move to the systemic level. What should regulators do? First, limit the maximum term of car loans. In some countries, a car loan can't exceed 5 years. In America, they give 8-year loans. Why? Because it's profitable for banks. Regulators should say, enough, 5 years maximum. If a person can't pay it off in 5 years, they can't afford the car. Second, tighten requirements for borrowers with low credit scores. Not ban lending to them. That would be unfair, but set reasonable limits. If a person has a 500 credit score and has defaulted 3 times already, maybe they shouldn't get $40,000 for a new pickup. Third, ban or heavily restrict debt rolling over when old debt is moved into a new loan. This creates an endless cycle of bondage. Fourth, demand more transparency and securitization of auto loans. Investors who buy these bonds must know exactly what's inside. The quality of borrowers, the real default risks. In 2008, high-risk bonds received high ratings from agencies. Buyers thought they were purchasing safe assets. They turned out to be toxic waste. The same thing may be happening with auto loan-backed securities right now. But here's the problem. Regulators are silent. They look at the growing mountain of debt and say, everything is under control. History shows they always say that. They said that in 2007. They said that in 2000 before the dot-com crash. They say that now. Why? Because regulating is politically inconvenient. If you tighten rules, fewer people can buy cars. Sales drop. Automakers get angry. Banks lobby against changes. And regulators want to keep their positions, so they wait. They wait until something blows up. And only then, when it's too late, when millions have already lost their cars and jobs, they say, well, we couldn't have foreseen this. Who knew? Everyone knew. They just didn't want to act. Financial institutions? And what about banks? GM Financial, Ford Credit, major lenders? They have no incentive to change the system at all. They earn billions, from people taking on debts they cannot repay. And even if the system collapses, what will happen to them? Look at 2008. The banks that created the crisis received government bailouts. They were saved at taxpayers' expense. CEOs got bonuses. Ordinary people lost their homes. The same will happen in an auto loan crisis if it occurs. Banks will be too big to fail. The government will step in. And ordinary people will be left with debt. The system works like this. Profits are privatized, losses are socialized. Banks keep the profits when things are good. And when things go bad, taxpayers pay. So is there hope? Honestly? I don't know. I see a system moving in a dangerous direction. I see all the signs of an approaching disaster. But I also know irrationality can last longer than we think. Maybe this house of cards will stand for 5 more years, maybe 10. Maybe there will be a soft landing. The economy slows, defaults rise moderately, the system adapts. Or maybe a year from now, we'll be watching the news about a major lender collapsing, panic in the bond market, massive auto repossessions. I'm not a fortune teller. I just look at the facts, and the facts say we're stepping on the same rake we stepped on in 2008. Final thought. Your car sitting in your driveway isn't just a car. It's part of a multi-trillion-dollar financial system built on debt. This system works as long as everyone keeps paying, as long as prices rise, as long as new borrowers show up to replace those who default. But when the music stops, and it always stops, it becomes clear who's been swimming naked. And when this system cracks, it's not the people who built it who suffer, not the bankers on Wall Street, not the CEOs of automakers, not the hedge fund investors. It's the single mother in Ohio who took a loan for a used Honda to drive her kids to school. It's the factory worker in Detroit who bought an F-150 because he needs a pickup for work. It's the young couple in Texas who stretched their loan to 7 years because it was the only way they could afford a car. These are ordinary people who just wanted to get to work, who played by the rules they were given, who believed that if the bank approved the loan, it meant they could repay it. And the system deceived them. And you know what's the most cynical part? When everything collapses, these same people will hear, "You lived beyond your means. You were irresponsible. This is your fault." Not the fault of the system that intentionally built the trap. Not the fault of the banks that lent money knowing people couldn't pay. Not the fault of regulators who looked the other way. No. The blame will fall on the ones who got trapped. If this video made you think, hit the like button and share it with anyone who's planning to take out a car loan. You might save someone from 7 years of financial slavery. See you in the next video.